We've all been told that debt is bad, that you should avoid it at all costs, that being in debt means you're failing financially. And you know what? Most of the time, that's absolutely true. Most debt will destroy your financial future, trap you in a cycle of payments, and keep you from ever building real wealth. But here's what nobody talks about. Some debt is actually good. Some debt makes you richer. Some debt is an investment that pays you back multiple times over. My name is Mike. And today, I'm going to tell you something that goes against everything you've heard from Dave, Ramsey, and every debt-free guru out there. Not all debt is created equal. And knowing the difference between good debt and bad debt might be the most important financial lesson you ever learn. If you want to understand which debt payments are actually worth making, and which ones are silently destroying your wealth, make sure to hit that subscribe button and give this video a thumbs up. Let's start with the fundamental truth that most people get backwards. Debt is a tool. Like any tool, it can build something valuable or it can hurt you. Depending on how you use it, a hammer can build a house or smash your thumb. Debt can build wealth or destroy it. The tool isn't good or bad. It's how you use it that matters. Here's the key distinction. Bad debt is money you borrow to buy things that lose value. Good debt is money you borrow to buy things that gain value or generate income. Bad debt makes you poorer over time. Good debt makes you richer over time. It really is that simple. But let's get specific because the details matter. Let's start with the most obvious example of good debt. A mortgage on a rental property. You borrow $200,000 at 6% interest to buy a rental house. Your monthly payment is about $1,200. But the property rents for $1,800 per month. After expenses like property tax, insurance, and maintenance, you're breaking even or maybe making a small profit each month. Now here's where it gets interesting. You're not making money from the cash flow, at least not much. You're making money because someone else, your tenant, is paying off your mortgage for you. Every month, $400 of that $1,200 payment is going toward the principal. Building your equity in 30 years. You'll own a property worth probably $400,000 or more, and you only put down $40,000. Your tenant paid for the rest, but it gets even better. Because while your tenant is paying down your mortgage, the property is likely appreciating. Real estate historically increases about 3 to 4% per year. So that $200,000 property becomes worth $240,000 after 5 years. Just from appreciation, meanwhile, your tenant has paid down maybe $20,000 of the principal. So you've gained $60,000 in value while only putting down $40,000. That's a 150% return on your investment in just 5 years. This is leverage. This is using debt to multiply your returns. This is good debt. Without the mortgage, you couldn't buy the property. The debt didn't make you poorer. It made you richer. The debt payment isn't a burden, it's an investment that someone else is funding. Now let's talk about your primary residence. And this is where things get controversial. Most people will tell you that your mortgage is good debt because real estate appreciates. But I'm going to push back on that a little bit. A mortgage on your primary residence is neutral debt. Maybe slightly good, but not great. Here's why. Yes, your house will probably appreciate over time. But you're not generating income from it, you're living in it. So while the asset might increase in value, it's not producing cash flow. You're still making that payment every month from your income, not from the asset itself. However, a mortgage is still way better than renting in most cases. When you rent, you're paying someone else's mortgage, building their wealth, not yours. When you have a mortgage, you're building equity, getting tax deductions, and betting on appreciation, so while it's not as good as investment property debt, it's still generally worth it. The math usually works like this. If you're paying $2,000 per month in rent, you could probably afford a mortgage payment of $2,000. Over 30 years, the rent money disappears completely. Builds zero wealth, leaves you with nothing. The mortgage money builds hundreds of thousands in equity, and you own an asset. Even if the house only keeps pace with inflation, you're still way ahead of renting. This only works if you buy a house you can actually afford. If you stretch yourself to buy too much house and you're house poor, unable to save or invest because all your money goes to the mortgage, then even this good debt becomes bad. The debt is only good if it doesn't prevent you from building wealth in other ways. Let's talk about student loans because this is where people get really confused. Everyone acts like all student loans are bad. And I get it. The student debt crisis is real. People are drowning in $100,000 of debt for degrees that don't help them earn more. But that doesn't mean all education debt is bad. If you borrow $40,000 to get an engineering degree that leads to an $80,000 starting salary instead of $35,000 without the degree, that debt just bought you an extra $45,000 per year. Every year, for your entire career, over 40 years. That's $80 million in additional earnings. You borrowed $40,000 and got back $80 million. That's good debt. The problem is that people borrow $100,000 for degrees that don't increase their earning power. They borrow private loan money at 12% interest to study something with no job market. They go to expensive private schools when a state school would give them the same credential for a third of the cost. They make emotional decisions about college instead of financial ones. Here's the rule for student loan debt. Only borrow what you can reasonably expect to earn in your first year after graduation. If you're going to make $50,000, don't borrow more than $50,000. If you're going to make $30,000, don't borrow more than $30,000. And if you're going to make $25,000, you probably shouldn't be borrowing anything because college isn't going to help your finances. This is harsh, but it's true. Not everyone should go to college. And among those who should, most be going to the cheapest option available. Unless you're going to an elite school that opens doors, Harvard, Stanford, MIT, the name on your degree doesn't matter as much as the field you study and the skills you develop. Nobody cares if you went to State U or a fancy private college 5 years into your career. Let's talk about business loans because this is another form of debt that can absolutely be worth it. If you can borrow $50,000 at 8% interest to start or expand a business that generates $30,000 per year in profit, you've just bought yourself an annuity that pays forever. Your payment on that $50,000 might be $600 per month or $7,200 per year, but you're making $30,000 per year from the business. That's a $22,800 annual return on borrowed money. In less than 2 years, the business has paid back the entire loan. And it keeps producing income forever after that. That debt didn't make you poor, it made you rich. It gave you an income-producing asset that you couldn't have created without the borrowed capital. This is how most successful businesses are built. They use other people's money, leverage, to grow faster than they could using only their own capital. If you have a proven business model and you can borrow money at a rate lower than your return on investment, you'd be stupid not to do it, and this is crucial. The business has to actually work. Borrowing money for a business that fails is devastating. You're left with the debt, but none of the income. This is why you need to be conservative with business debt. Only borrow what you can afford to lose if things go wrong. Have a backup plan. Make sure you've tested your business model before you borrow big. Now let's talk about what I call strategic consumer debt, and this is controversial. I'm talking about using 0% financing offers strategically. Here's an example. You need to buy a $2,000 laptop for work. You have the cash, but the store offers 24 months of 0% financing. Should you pay cash or take the financing? If you're financially disciplined, you should take the financing. Here's why. You keep your $2,000 in a high-yield savings account earning 5%. Over 24 months, that $2,000 earns you about $200 in interest. Meanwhile, you're paying $83 per month on the laptop at 0% interest. In month 24, you pay off the remaining balance. You got to use the laptop for 2 years and you made $200 from the deal. This only works if you're disciplined. If you spend that $2,000 on something else and can't pay off the laptop before the 0% period ends, you get hit with retroactive interest at like 25%, and you've destroyed all the value. This is how stores make money on these offers. They know most people will screw it up. So the rule is, only use 0% financing if you have the cash to pay it off right now. Sitting in your account, untouched, and you're disciplined enough to pay it off before the promotional period ends. For most people, this doesn't apply. They'll spend the cash and end up in expensive debt. But if you can handle it, it's free money. Let's talk about what is definitely not worth it. Because this is where most people destroy their wealth. Credit card debt for consumption is the worst form of debt you can possibly have. If you're carrying a balance on credit cards to buy things you consume, food, clothes, entertainment, you're actively choosing to be poor. Here's the math. If you carry a $5,000 balance at 20% interest and make minimum payments, you'll pay over $8,000 in total. You spent $5,000 on stuff that's now gone or worthless, and you paid an extra $3,000 for the privilege. That's not debt, that's financial suicide. Credit cards should only be used if you pay them off in full every month. If you're paying interest, you're using them wrong. The rewards, the points, the cash back, none of that matters if you're paying 20% interest. You're losing money on every purchase. Car loans for new cars are almost always bad debt. A new car loses 20% of its value the moment you drive it off the lot. So you borrow $40,000 at 7% interest to buy something that immediately becomes worth $32,000. You're underwater from day one and cars continue to depreciate. By the time you pay off that 5 or 6 year loan, the car is worth maybe $15,000 and you paid $50,000 for it when you include the interest. If you must finance a car, buy a 3 or 4 year old reliable used car and finance it for no more than 3 years. Better yet, save up and pay cash. Cars are necessary, but they're not investments. Every dollar you spend on a car is a dollar that can't be invested in assets that actually grow. Payday loans, title loans, rent to own. All of these are absolutely terrible. These are poverty traps. The interest rates are so high, often 300% to 400% APR, that you can never get ahead. You borrow $500 and end up paying back $2,000. If you're even considering these options, you need to fix your budget and build an emergency fund. Because you're in a financial crisis, personal loans for vacations, weddings, or other celebrations are also terrible debt. You're borrowing money to create memories, which is nice, but you're paying interest on those memories for years afterward. That $10,000 wedding loan at 12%. Interest means you're paying $13,500 for one day. And you'll still be making payments when you're planning your first anniversary. Here's a better rule. If you can't afford to pay cash for something that doesn't produce income or appreciate in value, you can't afford it, save up, buy it with cash. Or don't buy it at all. Borrowing money for consumption is almost always a mistake. Let's talk about medical debt because this is a special case. Nobody chooses to get sick or injured. Medical debt isn't the result of bad decisions like buying a car you can't afford. It's the result of bad luck and a broken healthcare system. So while medical debt isn't worth it in the traditional sense, it's often unavoidable. The key with medical debt is to negotiate. Hospitals and doctors will often accept much less than the full bill if you negotiate or set up a payment plan. Don't just pay whatever they initially charge. Medical billing is basically made up. The same procedure costs different amounts at different hospitals, and nobody pays the sticker price. Call the billing department. Explain your situation. Ask for a reduction. Ask for a payment plan with no interest. Many hospitals have charity care programs that will reduce or eliminate your bill if you qualify. Medical debt is one area where being proactive can save you tens of thousands. Now let's talk about the psychology of debt. Because even good debt can become bad if it stresses you out. Some people are psychologically unable to handle any debt. Even if the math says a mortgage or student loan is worth it, if having that debt keeps them up at night, it's not worth it. Financial decisions aren't just mathematical, they're emotional. If being debt-free gives you peace of mind, that's more valuable than the mathematical optimization of using leverage. Then pay off everything and be debt-free. There's no perfect answer that works for everyone. But here's what I'll say. If you avoid all debt, including good debt, you'll probably build wealth slower than someone who uses debt strategically. Someone who never takes on a mortgage will spend their life paying rent and building zero equity. Someone who never borrows for education or business might miss opportunities that would multiply their income. The goal isn't to avoid all debt. The goal is to avoid bad debt while strategically using good debt. Big difference. Here's how to think about any debt decision. Ask yourself these questions. First, what am I buying with this borrowed money? Second, will this purchase increase in value or generate income? Third, is the return higher than the interest rate I'm paying? Fourth, can I still afford my other financial goals while making this payment? Fifth, what happens if something goes wrong, job loss, market crash, emergency? If you can answer these questions honestly and the debt still makes sense, it's probably worth it. If you're rationalizing, making excuses, or ignoring obvious problems, it's probably bad debt disguised as good debt. One more thing about good debt. Just because debt can be good doesn't mean more debt is better. There's an optimal amount of leverage, and going beyond that is dangerous. If you borrow too much, even for good investments, one setback can wipe you out. Real estate investors who over-leverage, buying 10 properties with 10 mortgages, can lose everything when the market turns or they have a few bad tenants. Business owners who borrow too much can't survive a slow period. Students who borrow the maximum possible might get a great education but spend 20 years paying it back. The rule is, borrow enough to create opportunity, but not so much that you're fragile. You want to use leverage to amplify your gains. But you need to be able to survive the downside. So here's the bottom line. Debt is a tool. Mortgages on investment properties are almost always good debt if the numbers work. Mortgages on your primary residence are generally worth it. Student loans are worth it if they significantly increase your earning power and you don't overborrow. Business loans are worth it if you have a proven model and conservative projections. Strategic 0% financing is worth it if you're disciplined. Everything else, credit cards, car loans for new cars, personal loans for consumption, payday loans, is bad debt that will make you poorer. Avoid it. Pay it off. Never take it on in the first place. The difference between people who build wealth and people who stay broke often comes down to how they use debt. Poor people use debt to buy things that make them look rich. Rich people use debt to buy things that make them actually rich. Same tool, opposite outcomes. So stop thinking about debt as universally good or universally bad. Start thinking about it strategically. Use it when it makes you richer. Avoid it when it makes you poorer. And always have a plan to pay it back. Your financial future depends on getting this right.